Hello and welcome to Dinar Stories, your trusted source for calm, in-depth financial analysis. Today, we're diving deep into two interconnected topics that cause a lot of confusion: how money exchange systems really work and what currency revaluation truly means behind the scenes. We'll cut through the hype and focus on verified information, structural explanations, and the importance of patience. This isn't about panic or instant profits. It's about understanding how the global financial system evolves. Let's start with the basics of money exchange. When you think of exchanging money, you might picture swapping one currency for another at a bank counter. But in modern banking, it's far more complex. Every exchange is a transaction that must pass through layers of compliance checks, liquidity management, and reporting systems, all overseen by central banks. This process creates a detailed record that has to align with both national and international regulations. This is why informal or undocumented exchange methods are slowly being phased out. Banks prioritize the stability and integrity of the entire financial system over the speed of any single transaction. Their goal is to prevent illicit activities and maintain a stable economic environment, which sometimes means things move slower than we'd like. So, why do banks sometimes change their exchange rules seemingly without any warning? It's not to be secretive. It's a strategy called controlled communication. Banks rarely announce changes in advance because doing so could trigger market speculation, panic buying, or people trying to game the system. Regulatory updates, internal audits, or even pressure from international financial bodies can force them to make quiet adjustments. Often, these changes happen internally first, affecting how they process transactions long before any public policy is updated. When a bank suddenly tightens its rules or its staff becomes silent on certain transactions, it's usually because they are adapting to new directives. This behavior isn't unique to one country. It's a standard practice in global banking to maintain order and control. At the heart of all this is the central bank. Central banks are the ultimate guardians of a nation's currency. They supervise the flow of money, set exchange limits, and manage cross-border movements to protect the country's financial reserves and the credibility of its currency. They prefer to implement changes gradually to avoid shocking the economy. Commercial banks are required to follow the instructions from their central bank strictly and immediately. So, when a central bank adjusts its framework, commercial banks respond right away, often quietly, to stay in compliance. Their silence is simply them following orders from the top. Now, let's connect this to the bigger concept of currency revaluation. What is it, really? A revaluation is a deliberate, official upward adjustment of a currency's exchange rate against other currencies. This is the opposite of a devaluation, which is a deliberate decrease. A revaluation isn't a random event. It's typically the result of a strengthening economy, positive trade balances, or strategic shifts in monetary policy. Most importantly, it's not an overnight lottery ticket. It is a gradual and carefully managed process guided by a country's central bank to reflect its improved economic health. So, why would a central bank decide to revalue its currency? The main goal is to stabilize and strengthen the national economy. Before making such a move, the central bank analyzes key economic indicators like inflation rates, GDP growth, and foreign trade balances. A stronger currency can make imports cheaper for its citizens and attract foreign investment, which further boosts the economy. However, revaluation is usually part of a much broader package of economic reforms. It's a tool, not a magic wand. Central banks also coordinate with international institutions like the IMF and World Bank to ensure the revaluation doesn't destabilize the global financial system. It's a delicate balancing act. What does a revaluation mean for people holding that currency? While it can increase the international purchasing power of your holdings, it's not just about your money suddenly being worth more. It also affects the prices of goods and services within the country. As the currency strengthens, imported goods may become cheaper. But the nation's exports could become more expensive for other countries, potentially impacting local industries. This is why patience and sound financial planning are so crucial. The biggest misconception is that a revaluation leads to instant, massive wealth. The reality is a slow adjustment with ripple effects throughout the economy. It's also vital to understand the role of international factors. No currency exists in a vacuum. A country's decision to revalue is influenced by global economic trends, foreign investment flows, and even geopolitical events. For instance, a surge in demand for a country's main export, like oil, can naturally push its currency value up, making a formal revaluation a logical next step. International trade agreements and the policies of global financial institutions also play a significant role. A currency's strength is always viewed in a larger context, requiring international cooperation to maintain stability for everyone. This brings us to some common myths. The idea that you can get rich overnight from a revaluation is perhaps the most persistent one. This narrative is often pushed by speculators, but the real process is gradual and filled with economic complexities. It won't instantly solve a nation's deep-seated economic issues. True, sustainable growth comes from comprehensive reforms, not just a change in an exchange rate. It's essential to base your financial decisions on verified information and realistic expectations, not on hype or rumors. So, how can you best prepare and navigate these changes? The key is to stay informed and be patient. Follow credible news sources and learn to understand basic economic indicators. Instead of making impulsive decisions based on speculation, manage your currency holdings with a long-term perspective. If you have significant investments, consider seeking advice from a qualified financial professional who understands global markets. The best strategy is to remain calm, cautious, and well-informed. To summarize, both daily money exchange rules and major events like currency revaluation are part of a complex, structured, and carefully managed system. Understanding this system is the best way to navigate financial changes confidently. Confusion and anxiety often come from a lack of information, but with clarity and patience, you can make smarter decisions. Thank you for joining us at Dinar Stories. We hope this explanation brought you clarity. If you found this helpful, please like, share, and subscribe for more in-depth, reliable financial insights. Let us know your thoughts in the comments, and we'll see you in the next video.